Welcome to The Explainer. You know that feeling when you're terrified of losing money in the market, but at the same time you feel this pull to take big risks for big gains? Well, today we're going to break down a really powerful framework for conquering that exact feeling, and we're going to do it by looking at one fascinating case study. And it all starts with this quote right here. I mean, think about it. It's a huge contradiction that gets right to the heart of how we think about investing, that weird battle between fear and greed that's always going on inside our heads.
So let's get into the specifics. Here's the real-life situation. We've got an investor in Taiwan who owns multiple properties, but they're also carrying a lot of debt. Now, they're sitting on a pile of cash, $3 million to be exact, but they're absolutely paralyzed by the fear of a massive market crash. And here's the kicker, the unbelievable part. Their big plan is to borrow even more money to go all in on stocks. It's just a classic conflict, right? The fear of loss is at war with the desire for those huge returns.
So what is going on here? How can someone be so scared to invest their own money, but then be totally willing to go deeper into debt to do it? It seems completely illogical, but it turns out there are these powerful invisible forces driving this kind of thinking. According to the expert in our source material, this investor isn't really fighting the market. They're fighting two specific ghosts that haunt all of us. And these aren't just numbers on a screen. We're talking about deep, primal fears that can make us do some pretty irrational things.
And here they are. On the left, you've got the price ghost. That's the raw, gut-punch fear of just how deep the market can fall. And on the right, you've got the time ghost. That's the nagging anxiety of how long it can stay down. You know, what's so smart about this is that it gives these fears a name. Because once you can name your enemy, you can start to build a plan to fight back.
Okay, let's talk about that price ghost. It's easy to say, oh yeah, I can handle a 20 or 30% drop, but are you really prepared, mentally and financially, for this? For watching your portfolio get cut down by 80%? And then, the time ghost swoops in. Imagine that. After a huge drop, you have to wait a full decade, 10 years, just to get back to zero. That's what really grinds people down and tests their patience to the absolute limit.
So how in the world do you survive something like that? The answer isn't being some kind of genius who can predict the future. It's about having a system. It's about building a fortress of rules before the storm hits. A system that protects you when your emotions are screaming at you to panic and sell everything.
All right, let's build that system. The very first piece, the foundation of this entire fortress, is what our expert calls the cash wall.
Now, this is the #1 non-negotiable rule. You have to set aside enough cash to cover 3 full years of all your household expenses. And listen, this money is not for investing. It's your survival fund. For our investor, this meant building a cash wall of $3.9 million. That money is off the table. It's there to protect the family, period.
And this quote just nails it, right? It's the whole philosophy in one sentence. Before you even think about getting rich, you have to make sure you can survive the worst-case scenario. Security comes first. The cash wall is what guarantees you can live your life without being forced to sell your stocks at the absolute worst time. Okay, so the fortress is built, your cash wall is secure. Now, and only now, can we talk about a simple, unemotional way to actually get into the market. This is the part of the plan that lets you sleep well at night. The plan starts out really conservative. You can see here 50% of your assets just stay safe and sound in your cash wall. The other 50%, that goes into a broad market index fund, which is basically a simple way to own a tiny piece of hundreds of big companies all at once. The whole idea is to start safe, kind of dip your toes in the water, and get used to the market's rhythm before you do anything else. And this right here, this table, is your playbook. It's your standard operating procedure. You write these rules down on a little card before a crash happens when you're thinking clearly. This takes all the emotion out of it. The market drops 20%, you don't panic. You just look at your card and follow the script. It tells you exactly what to do. It turns fear into a simple, mechanical action.
So the big takeaway is that this requires a complete shift in your mindset. You start with a small amount you're totally comfortable with. You invest that same amount regularly, like clockwork. And then you completely reframe what a market crash means. It's no longer a threat, it's a sale. It's a chance to buy more of what you wanted anyway, but at a discount.
Now we get to what might be the single most important part of this whole explainer. Because look, the charts, the rules, the strategies, they're all totally useless if you can't emotionally handle the pressure when things get crazy. So this is about training your mind, about building your psychological muscle. And this timeline turns all those big ideas into a concrete, step-by-step process you can actually do. In the first week, Boom, you build the wall, you write down the rules. Then you start small, you automate it, set it and forget it. You create a system that runs in the background, without your emotions getting in the way.
I want you to think of this as a fire drill for your money. You practice these steps when everything is calm so that when the alarm bells are ringing for real, you act rationally, not emotionally. What do you do in a 50% crash? 1. Execute the plan. No thinking, just doing. 2. Protect the wall. That cash is sacred. 3. Tune out the noise. Turn off the TV.
And this is the final exam. When the sky is falling, when the news is screaming, and all your friends and family are panic selling, what will your hands do? The answer has to be, my hands will follow my script. I will go about my day, and I will trust the system I built for myself when I was calm and rational.
Okay, let's zoom all the way out and land on the single biggest idea from this entire framework. Because the solution here isn't about having more money. It's about doing things in the right order.
Our source material points out these 3 common mental traps that so many people fall into. First, there's the leverage trap, thinking that borrowing money makes you brave when it really just makes the fear 100 times worse. Then there's the dividend trap, confusing a little bit of income with true safety. And finally, the all-in trap, feeling like you have to dump a huge pile of cash into the market all at once. All of these are just shortcuts that ignore the proper sequence.
And this is the final diagnosis for our investor. Their problem was never a lack of money. They had plenty. The problem was the sequence was all wrong. They were trying to build the roof of their financial house, that's the stock portfolio, before they ever laid the foundation, which of course is the cash wall. And we're going to end on this powerful mantra because it just lays it all out so clearly. It's a sequence, a clear path to investing with confidence. Survive first, then you can think about getting rich. Cash first, then you can buy stocks. Build your tolerance first, and only then should you start chasing returns.